You buy a beachfront property in Florida, list it on Airbnb, and watch USD rental income roll in. The financial case is compelling. But if you hold a Canadian passport or live north of the border, that Florida property puts your income in the crosshairs of two nations. Because the physical dirt sits in Florida, the IRS demands their cut of the rent first. At the same time, the Canada Revenue Agency taxes its residents on their worldwide income. That includes every dollar your Floridists pay you. The difference in paperwork is stark. A local landlord deals with a single state tax return. As a cross-border investor, your requirements scale to include federal non-resident forms, state business receipts, local tourist tax registrations, and overlapping municipal licenses. Cross-border real estate is an active business. Success depends on the U.S.-Canada Tax Treaty, a framework protecting wealth only when executed with precision. Before you even think about federal taxes, you have to navigate Florida's multi-layered local regulations. The regulatory ladder starts at the state level. You must secure a transient public lodging license from the Department of Business and Professional Regulation. Next comes the county. You have to obtain a mandatory business tax receipt and register to collect and remit county tourist development taxes on every booking. Finally, the city layer. Municipalities like Pompano Beach or Fort Lauderdale require specific short-term rental permits. These often mandate physical safety inspections and hiring a designated local representative who is available 24/7 to answer compliance calls. This introduces real financial friction. These local permits carry annual renewal fees that typically range from $350 to $750. The risk of non-compliance is high. A single noise complaint or a missed permit renewal can trigger local fines of $1,000 per day. Operating a legal short-term rental means treating municipal compliance as a fixed business cost. It is a mandatory requirement to keep your doors open. Once your doors are open, the core challenge for cross-border investors is avoiding paying taxes on the exact same rental dollar twice. The U.S.-Canada Tax Treaty provides a mechanism called the foreign tax credit to prevent double taxation. This diagram illustrates the life cycle of a single rental dollar under the treaty. It starts as your gross income. Your first step is filing a U.S. Form 1040 to report this U.S.-sourced income to the IRS. Before the IRS takes its cut, that gross income drops through a filter of allowable U.S. tax deductions, which reduces the overall taxable amount. The remaining tax owed drops into the IRS bucket. Step 2 requires you to file a Canadian T1 return, reporting that exact same worldwide income to the CRA, creating a Canadian tax liability. To prevent you from paying twice, you apply the foreign tax credit. The amount you already paid to the IRS applies directly against your CRA bucket, neutralizing the corresponding amount of Canadian tax owed. The rule of the treaty is simple. You will ultimately pay the higher of the two countries' tax rates, but you will not pay both on the same dollar. Activating this treaty protection requires pristine alignment of your tax calendars and precise currency conversions. A dual-licensed CPA is a mandatory mechanism for protecting your return on investment. Meticulous expense tracking and U.S. depreciation rules can reduce your taxable rental income on paper, leaving more cash in your account. However, the IRS and the CRA treat property depreciation through completely incompatible systems. The U.S. uses a system that allows for cost segregation, letting you deduct large portions of the property's value quickly. Canada uses the capital cost allowance system, which is slower and more restrictive. If you optimize your deductions for the IRS, it creates a discrepancy when you report that income back to Canada. You might reduce your U.S. tax bill to zero, only to trigger a tax liability with the CRA because they do not recognize those same rapid deductions. Maximizing cross-border cash flow means playing two different rulebooks at the same time. It requires complex reconciliation to prevent a tax advantage in one country from becoming a liability in the other. Beyond income and local permits, there are international anti-evasion laws to navigate. The U.S. requires you to disclose all of your Canadian financial accounts to the IRS using FBAR and FATCA forms. Canada has a reciprocal requirement. You must disclose your U.S. real estate and financial assets back to the CRA every year. The penalties for non-compliance are automatic. Even an innocent mistake or a missed reporting deadline can trigger fines starting at $10,000 per violation. Filing these disclosure forms generates zero financial return for your rental business, but ignoring them carries financial risk that can erode your entire investment. This level of oversight confirms that cross-border investing is a highly regulated operation. Cross-border rental investing demands active, rigorous administration. This chart maps which profiles survive. We plot resources against financial return. The bottom left budget DIYer takes high compliance risks, leading to failure. The bottom right accidental landlord lacks coordination, consuming their profit. In the top right, the optimized investor builds a professional stack. These investors treat Florida property managers and dual-certified CPAs as fixed overhead to capture high yields and currency advantages. The U.S.-Canada tax treaty is a vital asset for cross-border investors, but it only protects those who execute it with precision. Cross-border real estate is a lucrative wealth builder for those who treat compliance as a shield. For those who treat it as an afterthought, it is simply